What if I told you that one of the most popular dividend ETFs in America, with over $71 billion in investor money, has returned a pathetic 0.61% over the past year, while its younger, flashier competitor delivered 4.34%? And here's the kicker. You're probably betting on the wrong one. By the end of this video, you'll know exactly which ETF belongs in your portfolio. But first, drop a comment right now. Are you Team SCHD or Team JEPI? Let's see if you change your mind by the end of this video. We're talking about two of the biggest names in dividend investing, the Schwab US Dividend Equity ETF, ticker SCHD, and the JP Morgan Equity Premium Income ETF, ticker JEPI. And in October 2025, these two funds are telling completely different stories about the future of income investing. One is a trusted veteran with a 14-year track record. The other is a 5-year-old upstart that's already managing over $41 billion, and the battle between them has reached a critical point that every income investor needs to understand. Let me introduce you to these two competitors because they couldn't be more different. SCHD is the reliable veteran. Launched way back in 2011, it's managed to accumulate a massive $71.48 billion under management. This fund charges an ultra-low expense ratio of just 0.06%, which makes it basically the Costco of dividend ETFs. Rock-bottom prices, no frills, just value. SCHD holds 103 positions in Dividend Aristocrats, companies that have paid dividends for at least 10 consecutive years. These are the blue-chip stalwarts of American capitalism, the healthcare giants, the consumer staple companies, the old-school industrials. For over a decade, SCHD has been the go-to choice for investors who want reliable dividend growth with minimal costs. It's been the boring, dependable choice that just works. But in 2025, this veteran is having an identity crisis. Enter JEPI, the flashy newcomer. Launched in 2020, JEPI has experienced absolutely explosive growth, reaching $41.27 billion in assets in just 5 years. That's not a typo. This fund became the largest actively managed ETF in the equity income space faster than almost anyone predicted. JEPI charges a higher expense ratio of 0.35%, which reflects its more sophisticated strategy. Instead of just buying dividend stocks and holding them, JEPI uses a covered call strategy, holding 125 positions and actively managing a derivatives overlay that generates premium income. It's the income generation machine, and investors are voting with their wallets. So why is everyone suddenly questioning the dividend investing Bible that is SCHD? Why are billions of dollars flowing into JEPI's more expensive, more complex approach? Let's follow the money, because the performance numbers tell a story that's going to shock you. The short-term performance comparison is brutal for SCHD investors. In 2025 year-to-date, SCHD has returned 2.84%. That's not terrible on its face, but JEPI has delivered 5.24% over the same period. That's a 2.4 percentage point gap. And in the world of large ETFs, that's massive. But it gets worse. Over the past 1 year, SCHD has returned a pathetic 0.61%. Let that sink in. If you invested $10,000 in SCHD 1 year ago, you've made $61. Meanwhile, JEPI has returned 4.34% over the same period. That's a devastating 3.73 percentage point difference. While the market was partying, SCHD was barely showing up. Now, SCHD loyalists will tell you to zoom out, and honestly, they have a point. This is where the story gets interesting because the long-term numbers paint a completely different picture. Over the past 3 years annualized, SCHD has returned 11.29% versus JEPI's 10.17%. The veteran fights back, and over the past 5 years annualized, SCHD has delivered 12.04% compared to JEPI's 11.61%. History clearly favors the patient investor who stuck with SCHD through market cycles. But here's what Wall Street analysts are whispering in October 2025. And this is the part you need to pay attention to. SCHD's problems aren't temporary. They're structural. Multiple financial analysts have specifically called out SCHD's fundamental strategic issues, and negative investor sentiment has accelerated dramatically in recent months. The question isn't whether SCHD had a bad year. The question is whether SCHD's entire approach to dividend investing is broken in today's market. And the answer to that question comes down to one word: energy. Let me show you the 20% mistake that's costing SCHD investors billions of dollars. SCHD's current sector allocation reveals a concentration problem that's become catastrophic. Nearly 20% of the fund, specifically 19.23%, is allocated to energy stocks. That means almost 1 in every $5 you invest in SCHD is betting on oil and gas companies. Consumer staples make up another 18.81%. Healthcare is 15.53%. And here's the kicker: technology represents only 9% of the portfolio. In 2025, when artificial intelligence is revolutionizing every sector of the economy, SCHD has minimal exposure to the companies driving innovation. Even worse, the fund's top 10 holdings represent 40.67% of total assets. That's a massive concentration in a handful of positions, which means sector-specific problems get amplified. Compare that to JEPI's balanced approach. JEPI has 18.1% in technology, putting it right at the center of the AI revolution with meaningful exposure to companies like Nvidia, Microsoft, and Alphabet. Financials make up 14.6%, industrials are 14%, and healthcare is 13.8%. This is true diversification across growth and value sectors. And here's the really important difference: JEPI's top 10 holdings represent only 15.81% of the portfolio. That's dramatically lower concentration risk, which means no single sector meltdown can destroy your returns. The energy problem has become so severe that Seeking Alpha analysts published an article literally titled SCHD: When 20% Energy Exposure Becomes a 100% Problem, Downgrade. That's not a typo. That's a downgrade based specifically on sector allocation. Imagine if your entire retirement strategy was betting that oil and gas companies would save you. In 2025, how's that working out? The data says it's not working at all, and analysts are openly questioning whether SCHD's index methodology has become fundamentally misaligned with current market dynamics. But let's talk about what really matters to income investors: the actual cash flow you receive. Because this is where the rubber meets the road, and the numbers are staggering. SCHD currently yields 3.78%, which translates to approximately $1.03 per share annually. If you invest $100,000 in SCHD, you're generating $3,780 per year in dividend income. Those payments arrive quarterly. Every 3 months, you get a check. The dividends qualify as qualified dividends, which means they're taxed at favorable capital gains rates for most investors. SCHD has a strong track record of dividend growth, with payments consistently increasing year over year as the underlying companies grow their dividends. It's steady, it's predictable, and honestly, it's boring. Now let's look at JEPI's income generation and prepare to have your mind blown. JEPI currently yields 8.33%. That's not a typo. 8.33%. That translates to $4.75 per share annually. On that same $100,000 investment, JEPI generates $8,330 per year. But here's where it gets even better. Those payments arrive monthly. JEPI's most recent monthly dividend in October 2025 was $0.361 per share. Your mailbox money arrives 12 times per year, not 4. For retirees who need consistent cash flow to pay bills, that monthly schedule is a game changer. Let me break down the math so you understand the real impact. On a $100,000 investment, JEPI pays you $4,550 more per year than SCHD. That's not pocket change. That's a vacation. That's a used car every year. That's your grocery bill covered. That's real money hitting your account every single month that you can spend, reinvest, or use to sleep better at night. JEPI's income doesn't come from magic, it comes from covered calls. JEPI is selling call options on its holdings and the S&P 500 index, collecting premium income in exchange for capping some of its upside potential. You're trading maximum capital appreciation for consistent current income. It's not free money. It's a strategic trade-off. In a raging bull market where stocks are up 30 or 40%, JEPI will lag because it's sold away some of that upside. But in choppy sideways or declining markets, JEPI's covered call strategy shines because you're still collecting that premium income regardless of what the market does. Now let's address the elephant in the room that every cost-conscious investor is thinking about: expense ratios, because SCHD's ultra-low fee is one of its biggest selling points, and we need to put it in perspective. SCHD charges 0.06% annually. On a $100,000 investment, that's $60 per year. JEPI charges 0.35% annually, which equals $350 per year on that same investment. The difference is $290 per year. SCHD advocates will tell you this matters enormously over time, and they're right. Fees compound. Over 30 years, that difference adds up to tens of thousands of dollars in a large portfolio. But here's the perspective shift you need to understand. JEPI costs you an extra $290 per year in fees. But remember what I just told you. It's paying you $4,550 more in annual dividends than SCHD. And it's outperformed SCHD by 3.73 percentage points over the past year. Sometimes you actually get what you pay for. Yes, over 3 decades, that 0.29% fee difference compounds significantly, but only if SCHD actually performs. And right now, in the market environment we're actually living in, it's not performing. The question isn't whether lower fees are better in theory. The question is whether you're willing to pay an extra $290 a year for $4,500 more in income and significantly better returns. That math works for most investors. Let's talk about risk and volatility, because this is where JEPI's covered call strategy shows its real defensive power. SCHD exhibits a standard deviation of 15.24% and a beta of 0.79 versus the S&P 500. That means SCHD moves about 79% as much as the broader market. It's got moderate volatility, which is reasonable for a dividend-focused fund. But JEPI demonstrates dramatically different risk characteristics. JEPI has a standard deviation of only 8.74% and a beta of just 0.59. That means JEPI moves only 59% as much as the S&P 500. It's significantly smoother, significantly less volatile. Think about what this means in practice. If you're retired and living on this income, if you're in the distribution phase of your investing life, which fund sounds like better sleep at night? The one that bounces around 79% as much as the market, or the one that moves only 59% as much? Those covered calls that JEPI sells act like insurance premiums. You're giving up some upside potential, but you're getting paid premium income for it, and you're getting meaningful downside protection. The strategy is literally engineered to be boring and consistent, to smooth out the volatility, to provide that defensive cushion when markets get choppy. So here's the real question you came here to answer. Which ETF should you actually own? And the answer is, it depends on who you are and what you need. Let me break this down clearly. Choose JEPI if you need income now. If you're retired or close to retirement, if you're in the distribution phase, JEPI's 8.33% yield and monthly payments are simply better suited to your needs. Choose JEPI if you want monthly cash flow instead of quarterly. 12 paychecks per year versus 4 makes cash flow planning dramatically easier. Choose JEPI if you prioritize stability and sleep at night quality. That lower volatility and downside protection matters more as you get older. Choose JEPI if you believe markets will continue to be choppy and uncertain. Covered call strategies perform best in sideways or moderately declining markets where you're collecting premium income regardless of direction. And choose JEPI if recent performance matters to you, if you're asking, what have you done for me lately? Because the answer for the past year is overwhelmingly clear. JEPI has delivered. But choose SCHD if you're young and still accumulating wealth. If you've got a 20 or 30-year time horizon, SCHD's lower costs and potential for mean reversion become much more compelling. Choose SCHD if you genuinely believe in value sector rotation, if you think energy and traditional dividend sectors will eventually rebound. Eventually is doing a lot of work in that sentence, but historically, value cycles do rotate back into favor. Choose SCHD if you're a true passive investor who values rock-bottom costs above all else. That 0.06% expense ratio is genuinely beautiful for long-term compounding. Choose SCHD if you trust long-term mean reversion and you believe that 5-year track record of 12.04% annualized returns represents the fund's true character rather than the past year's 0.61% disaster. And choose SCHD if you have conviction and patience, if you can genuinely wait 3 to 5 years for a potential value rotation without panicking. But here's the honest truth that I need you to understand. Investing isn't about being right, it's about being less wrong. And right now, betting against SCHD's 14-year track record feels uncomfortable. The fund has proven itself over more than a decade through multiple market cycles. Dismissing that history completely would be foolish. But betting on SCHD's last 12 months of performance feels absolutely terrifying. A 0.61% return when you could have had 4.34% elsewhere is the kind of opportunity cost that destroys long-term wealth. Now, I want to hear from you in the comments. Did I change your mind? Are you a SCHD loyalist who's sticking with the veteran through thick and thin? Are you a JEPI convert who's chasing that 8% yield and monthly income? Or are you playing both sides with a blended allocation? Drop your thoughts below, and if you found this analysis valuable, smash that subscribe button. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.